And comments?
Dividends are earnings based on one's shareholding in a company, at least until the Finance Act of 2018 came into force. The new law widens the purview of what will be deemed to be a dividend to include any cash or asset distributed by a company to a shareholder or a person related to a shareholder. While this is aimed at helping the government widen its reach for mobilization of revenue, tax consultants opine that it creates a grey area which is likely to put the government and taxpayers at odds.
Practically anything that is paid out of a company could be deemed to be a dividend. So for example, if you owe a debt and in your company which you are a shareholder or which your significant other, your spouse, is a shareholder, and that company settles your debt, then you will be deemed to have received a dividend.
The widened scope is expected to trickle and have an adverse effect on appetite for certain fixed income securities, potentially decelerating investor activity at the capital market.
Take an example of a company which has invested in an infrastructure bond. The income from an infrastructure bond is tax exempt. Now, when you want to distribute that income to your shareholders, because you did not pay tax on it in the first instance, you will be required to pay 30% tax on that income. So the question then becomes, what is the use of even investing in this infrastructure bond if I have to still pay 30% tax before I distribute?
The Finance Act of 2018 is expected to widen the tax base and rake in more revenue for the government. Stakeholders, however, contend that grey areas regarding the effective date of certain provisions are likely to derail realization of this goal. Julian Samboko, NTV.